seconds. It's also a four-seater. You can't put giant people in the rear seat. It's be available in 2020.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. You're watching IndianOpen and I'm Neeraj Shah. Good morning, Neeraj.
Good morning, Neeraj, and a very good morning to all of our viewers. Let's get you the headlines this morning. It's been a wild ride for the Bitcoin, bounces back from a sharp dip below 10,000 to back above it. A tab on spending helps Hindustan Unilever post a strong performance in the October to December quarter. Bharti Infratel may have had an operationally strong Q3, but outlook remains bleak. Airtel, UltraTech, Yes Bank, Adani Ports are the four nifty companies that are out with earnings today.
Okay, let's take a look at the trade setup for the day. Now, firstly, keep in mind that while Europe didn't have a great day yesterday, the US markets closed with a bang. Let's bring up the US markets first, then bring up the rest of the Asian markets and the SGX Nifty too, to show you the color, and the color is green. That's about 1.25% for the Dow, Nasdaq, S&P 2 going up about 1% higher and closing about 26,000. So it is a good day for the US markets, and that might be reflecting in what the Asian markets are doing in the session today and what the SGX Nifty is indicating. About 37 odd points. So we'll start off with record highs for almost all the key indices in the session today as well. And remember, that is carrying on the momentum because there was a late hour surge that we saw in almost all the key indices. At 2 p.m. yesterday, the broader markets were lying flat. Then the Sensex notched up again above 35,000, closing comfortably about 35,100. And all of that led to this index doing very, very well. The Nifty closing in about 10,800. So it looks like we'll set for much higher levels as well. Flows positive. FI cash numbers northwards of 600 crores. This would be one of the larger numbers, not terribly large, but one of the larger numbers that we've seen in 2018 as well. So FIs have continuously been on a buying mode, and this is not different. And there's a bullish formation being formed on all key indices. We'll talk about this on the banks as well. But Nifty's formed a bullish engulfing pattern. Let's see if this takes the index higher and if there are some technical factors that could lead to the index performing even better ahead of the expiry, ahead of the union budget as well. Just watch out for activity on the large caps. The last 2 or 3 days have been all about what's happening with the large caps. Mid caps have performed, but the indices haven't performed in line with what the large caps have. Matter of fact, 2018 has been a year of large caps and the Nifty outperforming the broader markets. So let's see if that mode continues. What to watch? I thought the Nifty Bank, and we talk about the fundamentals notwithstanding. I think if you just look at what the brokerages have come out based on the back of the news that CNBC TV 18 broke about the FDI limits in banks going up, it should just, if at all people believe that this were to happen, and remember RBI in the past has rejected this. I'm not going into the merits and demerits, I'm just saying that from a market perspective, there could be some activity out here on the banking space today as well. Yesterday, the Bank Nifty was very active. Yesterday, the PSU banks were very active. And just want to highlight one chart from a technical parlance. This is the PSU Bank chart. And yesterday, after closing below the 200-day moving average, the PSU Bank Index, because of the news that came out, closed above yesterday's opening highs. And that, I think, augurs well because it simply means that it took off all the shorts that would have been there and at least some of the shorts took everybody by surprise. And that typically, from what Pradeep tells me, for the PSU Bank Index, if history is to be believed, augurs well.
Sorry to interrupt, Neeraj, but I doubt that the PSU Bank Index was up due to the FDI news. I suspect it was up because of the bonds.
Bond news, yeah, that's what I said.
Yeah, because the
news that came
news,
out in the morning.
Yeah.
No, that's what I said.
Yeah, so the FDI news is irrelevant to the PSUs.
No. So the FDI news is great for the banks per se.
Private banks.
Yes.
Small group of private banks.
Yeah, and the PSU banks yesterday, any which ways, were doing well. So if both of these are to be taken into account, it should do really well for the bank index as well. So just wait and watch if indeed from a market perspective, this augurs well for the banking space by and large. Stocks to watch aside of banks, of course, which we will talk about during the course of the day, I'm sure. HUL, I thought it was a strong quarter, volume growth, margin expansion. I thought the management commentary, they said that sequential recovery in the demand environment, which is expected to sustain. A pretty strong statement. The numbers came out post-market hours, so expect the stock to react. I think Agam will be best placed to speak more about this, but do watch out for HUL, could react today. I thought it was a very strong quarter of margin expansion for 2 or 3 names that came out overnight. So Adani Transmission, very good margin expansion. Thirumalai Chemicals, extremely strong numbers, but the number that stood out for me, I think, was Mindtree, from 8.2% to 12% EBITDA margins for a mid-cap IT company. I think it was exceptional. Morgan Stanley, Credit Suisse, everybody's given a bump up to their numbers or the coverage today on Mindtree. Do watch out for this one. Even though it's had a rally, there could be a reaction thereof in all 3, but Mindtree in particular, do watch out. And I don't know fundamentally how big is this for Varun Beverages, but typically the last few days, whenever it's won a state or a couple of states from PepsiCo, it's tended to make a big up move. Let's see if Bihar leads Varun Beverages to some more upsides in the session today. The news is that they're going to acquire the franchisee rights for PepsiCo in Bihar. So Varun Beverages could be an interesting one to watch out for in the session today. So lots of positive reactions expected. Let's wait and watch if indeed all of these turn out to be true or not.
All right, that's the trade setup. Just telling you what's coming up on First Word, editorial focus here on the show. It's been an eventful week for bonds. It's been an eventful year for bonds. We'll sum up all the hectic activity that took place on Wednesday, but also tell you that if you strip out all that volatility, what's the outlook for bonds? We take a look at the key takeaways from the country's largest FMCG player, HUL's earnings. Reliance Jio is expected to spoil the party for Airtel yet again. We get you a sense of what to expect from that company, and if 2017 was a blockbuster year, 2018's not been so far that great for cryptocurrencies. A volatile ride for the Bitcoin. We'll tell you what's happening there. I am going to start off with bonds though. So I think yesterday, just as the market had opened, you finally got news that the government is cutting their borrowing program. The earlier additional borrowing number was at 50,000 crore. The government came and cut it in to about 20,000. Pull up that first chart, which I'm just telling you the week that it has been for the bond markets, and it's not even the end of the week. It's only Thursday, so we've only had 3 trading days. You started out no, I want to go to the full week chart for this current week. So I think you started out okay, and then Monday evening you had the FIMDA dinner where Viral Acharya took a very strong stance on bonds. And I want to explain why it impacted the bond trading and the bond yields. So apart from the fact that he was talking about treasury risk management, I think treasury managers took away the fact that perhaps the regulator is signaling a lower intervention regime in bonds, because he did say that treasury managers should manage their own risk. So some treasury managers came away from that thinking that the RBI is signaling a lower intervention regime. Also, he had spoken about the fact that there is just too much exposure to interest rate risk in bank treasuries. Again, some treasury managers came away with the impression that the regulator is not happy with so much money being parked in government bonds. Now, I don't know whether that was the intent of Viral Acharya's speech, but that's what part of the market read into it. So you saw a 10 basis point, very sharp spike in the benchmark 10-year bond yields, which meant that even the new 10-year, which is typically trading at a lower yield, jumped up to levels of about 740 odd. Now, the market already was nervous. You'd had 2 bond auctions not go off okay in the month of January. The first one had to be cut down. The second one got closed well beyond trading time. So the market was nervous, and then you got that yield spike on Tuesday. So there's something had to give, and the government perhaps had no option but to come and announce a borrowing cut, because in the current circumstances they may not have even been able to complete that borrowing cut. So now what you have is the fact that you have gone back to levels before, Viral Acharya's speech, but that doesn't mean that bond markets have calmed down. This chart is just simply showing you all that has happened over the last 1 year or so, from the sharp dip on demonetization to the sharp rise on the RBI's policy stance change to lower inflation, once again bringing yields down, and then there has been a steady climb up on account of the government's fiscal concerns. Now, you take away those one-offs and try and see what the outlook for bonds is from here on. You may have seen the spikes calm off, but the outlook still remains slightly worrying, because there are a lot of unanswered questions. We're not saying that it's going to be worrying through the course of the year, but we're saying that till these questions get answered, bond markets will remain tentative. What are these questions? Well, the first one is that, we got a number of borrowing for the current fiscal. What is the number for the next year? Both the fiscal deficit target and the borrowing number. Until you get an answer to that in the budget, the market will remain on tenterhooks. Inflation, we've seen a 4.88% print. We've seen a 5.2% print. How long will inflation remain above 4%? And now that we have a 4% midpoint target, how long will the MPC tolerate 4% plus inflation, and when will they start to actually pull the trigger towards rate hikes? Where will oil prices go? If last year's assumption was that you stay between 60 to 65, is this year's assumption that you stay between 70 to 75? Higher than that? That question needs to be answered as well. And finally, liquidity conditions and what they will look like in FY19. The MPC at the last time had said that they expect neutral liquidity when you hit the start of the new financial year. But what happens beyond that? Just a brief mention of the currency in circulation numbers that came in yesterday. Currency in circulation is rising, which means that liquidity will tighten because that is currency leakage. Now, all of those are playing into the uncertainties in the bond market. So yields, for now, will remain elevated, even though the one-off spikes up and down, which are event risk, may have, well, between the two event risks of this week, have balanced themselves out.
So what you're saying effectively is that, yesterday's borrowing cut, was it necessarily because the government thought that it could live with less money? Because, let's say, some other estimates turned out to be better than expected? Or was it just that they thought that they'd fail in being able to raise that money?
It's tough to know. It could be either, because as people pointed out, that the first two auctions did not go well. And, it's very possible that they would have been in a situation where you had consecutive auctions starting to come off short, or they had to borrow at very, very high yields, which the government would not want to do, both from a signaling perspective, but also from its own finances perspective. They came in and said that we have taken, a relook at the revenue and the expenditure side, but they didn't give you any detail on that.
Yeah, because I think they announced the 50,000 crore before the last GST numbers in December. The GST numbers come usually on the 27th of December.
Yes, they came in after. The day after.
So nothing has changed, at least on the indirect tax front, unless they've suddenly seen a big bump up, in just the filings, etc. Because the actual numbers, when they collate, it will only come out towards the end of January.
Yeah.
The only thing that's changed is yesterday they put out direct tax numbers.
Yeah.
And those show an 18% growth in the April to Jan 15th period, which is substantially higher than the corresponding periods previous month, but still we don't know where they are on the, the deficit front. They're comfortable on the divestment front, but we don't know where they are on the tax revenue front as yet.
Yeah, and then I think Bloomberg reported that, there's an RBI dividend, extra dividend being talked about, but again, we haven't seen confirmation of that news. We didn't see that story getting, sort of expanded out through more details.
No word from RBI.
No word from the RBI.
So not clear whether they have been able to manage their finances better, or they just are too scared to go to the markets at this point in time.
It could be either.
To raise money. Is this market signaling higher rates this year, that means?
It is signaling higher rates, unless, of course, by some means, or, there is expected buoyancy in GST or something else which allows them to stay at least 3.2. I think it'll be tough if you do 3.5 in fiscal 18 to do 3 in fiscal 19. But if somehow you manage to see 3.3 or so, 3.3 and a half, 3.4 in fiscal 18, and you say 3.2 in fiscal 19, that may calm things down. And then if inflation stays along, expected lines, and oil doesn't do well, much more than what it's done.
Too many ifs.
Yeah, too many ifs.
Fair enough. You can read Ira's piece, though, on the comments made by Viral Acharya. It's on BloombergQueen.com, and it speaks of the dilemma and difficulty that the bond markets have been experiencing for the past several months. Let's move on to earnings season now. Hindustan Unilever has had a very satisfying third quarter. The country's largest FMCG company saw its top line grow more than 10% in the last 3 months of 2017, and even higher raw material costs was not able to dent the bottom line. Agam Vakil standing by to tell us what's working in HUL's favor. Agam?
Well, I'm going to go through the key highlights as far as this quarter goes. So starting off with net sales, that's moved up by as much as 11.5%. And we've also seen a substantial expansion in operating margins, coming in at around 19.6% in comparison to 17.5%. And so what is it that's driving growth as far as the top line goes? Well, volumes coming in at a robust 11%. Do remember, we do have a decline of as much as 4% in the comparable quarter last year, largely on account of demonetization. But what is it that's driving volumes? Well, when it comes to personal care segment, it's brands such as Pears and Dove, and the home care segment, it is brands such as Vim. We have seen an expansion in margins, but this is largely on account of the company's cost-saving initiatives, no help coming in from raw materials costs, which have seen an up move. So if I actually compare the raw materials costs to the revenues, it stands at around 37% in comparison to 31% in the same quarter last year. So there certainly has been a big up move. The management spoke about inflation in input costs, and this is largely on account of crude-linked raw materials. So that could be a matter of concern as we move into the next couple of quarters. But when it comes to growth, the management is very positive with respect to improving volumes going in.
Okay. Raw material costs, any idea on how much more they could increase by?
Well, it'll completely depend on crude, but if crude continues to stay here, then, well, margins could see a contraction of anywhere between 100 basis points to 150 basis points from here.
How did they sound on rural growth compared to last quarter?
Very positive, and that's very, that's evident in the volumes that we've seen.
I thought one statement from the management stood out for me, and they said that they are seeing sequential recovery in the demand environment as a whole, and they believe that this will sustain. So if all the question marks raised about volume growth in the first half of the last calendar were a problem, they certainly seem to be squashing those notions about there being question marks on the demand and volume growth at least.
If I can put the volumes number into perspective,
Sure.
over the last 6-7 odd quarters, what we've seen is volumes continuing to remain within the 5% range.
Right.
Now, if you remove the decline of 4% in the previous comparable quarter, you still have an up move of 6%. So it's not just the base effect. The company has certainly seen an improvement in demand, and that's resulted into this uptick right now.
And it ties in with the commentary that Jyoti Labs gave us yesterday on Countdown 2, and we spoke to them and talking about how would the volumes pick up. So he said, save for one or two pockets wherein, according to him, because of their relaunch and rebranding, they've gone slow. A lot of other key brands for them, and Jyoti is probably more rural than this one is, and more home care than maybe HUL would be as a percentage of its overall portfolio. And please correct me if I'm wrong here, Agam. But I think their commentary also was that the demand numbers are looking very, very strong compared to what they've seen the whole of calendar year 17.
Wow. So I think across the board, we're seeing companies say that the demand seems to be reviving in some fashion. That can only be good news. Thanks very much for that, Agam. That's HUL. We're moving on to Reliance Jio.
Yeah, so we thought since numbers are on a roll, let's talk about Airtel, because Reliance Jio's onslaught is expected to hurt Airtel yet again. The company may see its average revenue per user fall for the 6th straight quarter when it comes out with its third quarter numbers later on today. Sameet is here to tell us what the key expectations are and the key things to watch out for. Sameet, good morning.
Good morning, Neeraj. So, third quarter number for Bharti Airtel is expected to be weak. Revenue is expected to fall by around 3% to 21,900 crore rupees, while EBITDA is expected to fall by 5% to 7,550 crore rupees. Now, this EBITDA number of 7,550 crore will be the lowest in the last 15 quarters. Margins are expected to contract to 35.8%, while this is something surprising. The net profit is expected to rise by 5% to 359 crore rupees, and this will be the first time in last 6 quarters where the net profit is going to see an uptick compared to the last quarter. Now, ARPU, that is the average revenue per user, and the key number for an telecom company, is expected to come in at 129, and this will be the lowest ARPU that the company will be reporting. And this is the 6th consecutive quarter where the ARPU is expected to fall. So from 196 in first quarter financial year 2017, the ARPU is now is expected to come down to 129 rupees. Now, why such a weak quarter? Well, 3 reasons. First is a 57% cut in the interconnect usage charges, which was made applicable from 1st October. Now, this will not only impact the revenue of the company, but also the EBITDA. Second, we also saw ARPU down trading, that is customers choosing for lower ARPU and higher duration package or recharge package, which will lead to an ARPU fall in this quarter. And last but not the least, Reliance Jio. There is a continued competitive intensity that Reliance Jio brought in. That was the second reason, and this is the ARPU down trading reason. And what to watch out for would include, first thing that would include is capital expenditure that the company is planning for the next quarter and for this next financial year. And secondly, how they're going to fund it and what will be the leverage ratio that they will be comfortable with. Also, we'll have to watch out for the timeline on management commentary on the timeline of completion of the recent acquisitions that the company has done. Along with this, now the company in the last quarter made it very clear that they are looking to sell further stake in Bharti Infratel, and in fact they are also looking to sell majority stake in Bharti Infratel. So any commentary or any outlook coming in from the management on that side will be a keen thing to watch out for. Also their outlook on Africa business, because this is the business that has been saving Bharti Infratel for the last few quarters. So what is the outlook on this business and how this business performs will also be a key thing to watch out for in this result.
I was curious, you pointed out that all the parameters will be lower except for net profit?
Yeah, that could be because in this quarter you saw the company garnering around 5,000 crore rupees by selling their stake in Bharti Infratel, and also so it could be the lower finance cost which could lead to an uptick in the net profit.
Okay, all right, great.
Yeah,
okay.
Curiously, I had the same question in my mind. That
Yeah,
why is it everything else is down and profits are up?
Okay, great. Thanks very much. That's what's coming up for Bharti.
And lastly, I thought Bitcoin or actually all cryptocurrencies. I saw a nosedive before some bit of resurrection, but as our headline said, Ira, 2017 was a great year. 2018 has been anything but great for almost all of them.
Someone renamed it shitcoin on Twitter. I think there's just so much commentary on crypto nowadays. So someone said, doesn't Bitcoin deserve to now be shitcoin? And I just thought that was amusing. So.
It was.
Yeah.
No, but I think across the board, yesterday I was saying Ethereum has come off, almost all cryptocurrencies. The chart there is very interesting. We just have taken the two main currencies, which is Bitcoin and Ethereum. I think both of them show that from the highs, there has been a 40% drop down and a move sub 10,000 before recovering yesterday.
I think we should call them crypto something else.
Yes, I was just saying.
The use of the word currency.
It's me that we call them currencies, and I thought I'll get scolded again.
You missed her scolding yesterday since you were not here on the show.
Okay.
Yesterday was the turn of the rupee, today was the turn of the bond markets. Or less the bond markets and more
But
the
yes,
RBI. No, but so on a serious note, I think maybe we should not call it cryptocurrencies.
Crypto is fine.
Because what currencies fall 40% like, in short periods of time.
Yeah.
So it's interesting, but yeah, it's just been crazy. I think it's recovered above 10,000 now.
Yeah.
It's tough to keep track, right? You've got whipsaw, isn't that what it's called? When your head is like whipsawing around.
Yeah.
So, yeah.
But what was the reason? There was none.
I think a lot of countries are cracking down from a regulatory point of view on ICOs, on the trading that's going on some of these cryptocurrencies. And I think it's just the fear of enhanced regulation is what some people are pointing out. But I'm not going to pretend that I understand this at all. This is just what I read from the various news reports of people who do understand cryptocurrencies mention that, it's possibly to do with fear of more regulation.
And as I read it, so just because we were talking about it, apparently there is a crypto stroke currency called BitConnect, which has plunged more than 90% because the news was that the company behind it was moving to shutter its lending and exchange platform amidst a lot of scrutiny. So you never know what could spook any of these currencies, including regulatory concerns, or the company might suddenly feel that, hey, we want to change the platform or whatever it may be, as is the case of BitConnect. 90%.
You bought a Bitcoin, didn't you?
No, I didn't.
No,
You
come
did?
on now, be honest.
No, I didn't.
You were very tempted to buy a Bitcoin.
I was very tempted to buy a Bitcoin, yes, just to try and understand.
One or several of them?
If he's buying several, then
Then this is a network disclosure.
Yes, I know.
All right. Well, that's the story on Bitcoin. Never know which way it goes. But as of now, it fell below the 10,000 mark and then recovered a little above that. That's all we have on First Word this morning. Lots lined up, though, on Indian Open today. Are there more legs to the Indian market rally? We ask Manishi Raychaudhuri of BNP Paribas. We discuss expectations from today's GST Council Meet with Pratik Jain of PwC. Keep a watch out on that. And third quarter earnings fine print with Sanjay Pattnaik of Tata Sponge Iron. Also, to understand if commodity-related stocks will continue their run-up in 2018 and what he makes of all these insolvency proceedings in steel companies, Rakesh Arora of Go India Advisors will be joining us. You want to stay tuned for all of this? So please do that. Take a break now, but come back for more. What do we want from our country today? From the economy, from the politicians, the policymakers?
Do we want a better deal?
Maybe more perks for smaller businesses or large businesses or any businesses.
Do we want it to be easier to create something new? to find the job of our dreams, to create jobs for dreamers.
Do we want growth? Not just for the sake of growth, but for what it represents.
Not just numbers on a graph somewhere, but prosperity that we can see, touch, feel.
These things we want.
Can we expect them realistically?
It's time. Time for us to accept less and expect more.
Time for us to get on the path to confidence once again.
Time to go from making promises to keeping them.
From manufacturing slogans
To really making in India.
From a promising economy
To a delivering economy.
Can this budget mark a return to confidence?
Watch Budget 2018 with Bloomberg Quint. Back with Indian Open right here on Bloomberg Quint with me, Shah and Pradeep Pandya. And hey Pradeep, it looks like if we thought that the party had begun yesterday, whether it will continue or not, certainly seems like it's continuing. And the mother market is contributing. Dow, a handsome rally and leading to the SGX showing what we could do today.
Yeah, so that's interesting. Dow recouped all the losses that were incurred day before from day's high. It closed above previous day's high as well, closed above critical levels. And similar things we had seen in banks yesterday in our markets, and we were actually discussing towards the closing time.
I used your chart, by the way, in the morning.
Yeah, so that actually told you that, the previous day's highs were taken. So similar patterns, which means, there is something still in store. And at least for us, in India, till the time budget is out, now there would be all sorts of stories coming out, in run up to budget. We would know what is true and what is not, what actually happens and what doesn't happen only after the budget. So till then, it would be risky to short. I think that's the clear message that traders got yesterday, and that's very clear.
And how? I think traders got the message loud and clear. Well, let's talk about all of that and more, and full focus on the derivative space. First, get in Agam Vakil, who's standing by with the FNO setup. And Agam, good morning yet again. If it promises to be a good morning for HUL, it certainly promises to be a good market for almost everybody who was long on the markets yesterday.
Certainly, Neeraj. On an intraday basis, we saw the Nifty hit 10,800. It's the way SGX Nifty is indicating we're likely to open above that mark. And should we sustain above that mark, well, bulls are going to be coming in with full flow. But in what's happened yesterday, we've seen about a 2.5% increase in open interest as far as the Nifty futures go towards longs. And it's the same for the Nifty Bank futures as well, which has also seen a 5% addition as far as your longs go. What's happened to the VIX is that it's fallen, since surprisingly, because one would have expected an expansion in option margins or option premiums. That said, with respect to the Nifty put call ratio, that's moved up, but this is natural because we've seen the indices move up as well. This also means that there is more amount of put writing. And speaking of put writing, the most active option was the 10,700 put, as you can see here. As one may have said, that we could have expected a little more writing in the 10,900 or the 11,000 calls, but as you can see, there isn't any. In fact, there is unwinding there. So, well, it's open for the Nifty to move up. Now, in terms of changes in the FNO band, we're seeing GMR Infra and HDL move into the band, expect restricted trade there. But we're also expecting Jet Airways, Reliance Communications, and Wockhardt to resume trade to normalcy, given they are out of the FNO band. And HDL is one counter I'll be watching out for, considering the kind of longs that we saw in yesterday's day of trade. But once again, all eyes will remain on the benchmark index, that is the Nifty, and what levels it holds in store as we move into trade today.
Thanks, Agam, for this update. Abhijit Phatak, Director at Defined Edge Solution, joins us on the show. Abhijit, good morning. As Agam was just pointing out, bulls are really confident of further up moves, while bears are not really taking any positions. What do you think could be targets and strategies on both the indices, Nifty and Nifty Bank?
Good morning, Pradeep. Yes, the Nifty has broken out yesterday from the 10,750 resistance, and on my charts, I think it is headed towards 10,950 or maybe 11,000 this expiry. And any dip should be used to be buying either Nifty futures or Nifty call. I would if someone is a bit hesitant in buying futures, 10,800 call, it might gap up today, but on every dip that should be bought, and with a stop loss of 20. Right now it is 57. So the stop loss is a bit far, but then it might be worth it because it might be heading towards 100 plus on the call.
Okay, so like you explained last time around, you were talking about 10,720, 10,750. Now you just mentioned 11,000. Is that a possibility? Is that what your option calculations are telling you, like you told us last time around?
Yeah, now all the straddles have turned up, which is a very positive sign for the Nifty, and that is why I am saying that it has broken out. And from the options chart itself, 10,800 has a target of 125, which gives a target of Nifty around 10,925, 10,950. That is why I said one should buy that on every dip.
What's the stock idea for the day today, Abhijit? Good morning.
Good morning. One stock which has sort of trapped bears yesterday was the State Bank, which dipped below 300 because a lot of people had a stop loss of 300 on it, and then shot up after that, and now I think it has started a new run. It should go towards 320, 325. So any dip in State Bank near 309, 310, I doubt, because it might open gap up, but then any dip should be used with a stop loss of 306 to buy for a target of 320, 325.
Abhijit, I just have one question. Yesterday, Money Control put out a note citing sources that contract sizes may go up from 5 lakhs to 10 lakhs. Is this a material move for any of the related sectors, stocks?
To be honest, I'm taking it with a pinch of salt, because this is not the first time we have heard about this. I think this has come up at least 3 or 4 times earlier, number one. And so I'm not sure whether it will be really done, because if it is done, I don't agree with it in the first place. Second thing is, they are talking about 10 lakhs lot size. I don't understand what do they mean by 10 lakhs, because right now if you see most of the stocks, including Bank Nifty, if you see the lot size right now in terms of their current price and the lot size, they are already 10 lakhs. So I don't know what they are going to change. I mean, it's just the same lot size. So that is number 2. Number 3 is at the same time they are talking about adding weekly options to Nifty. So on one hand they are encouraging more trading in derivatives, and on the other hand they are saying this. So it's really confusing. So I don't think one should take it seriously for the time being.
Very important point actually, because ever since the Nifty Bank weekly option has come in, some of the seasoned traders are not really happy about it. They think it's too much of a speculation. They were more comfortable taking position for the entire month. And second thing, when you increase the lot size, what also happens with options, the experience is that option writers make more money. And every time you try to increase the lot size and drive the smallest guy out of that market, he cannot write options, because
I think the small guy is anyways out, Pradeep. I agree with your point that
what they're actually doing is they're buying options because it's cheap to buy. You can just bet for 2,000, 3,000 rupees, and you can buy an option in Nifty, and you tend to lose money. So do you want them to lose more money, or do you want them to kind of graduate and trade professionally?
No, I agree with your point. That point is well taken. But yeah, somehow, all the recent actions too. What the point I was trying to make is a lot of recent actions too have kind of driven the small investor away. I don't know if Abhijit agrees with me or you agree with me, but I think it's largely become an HNI dominated market, to be honest, even currently. Again, my personal views really may change, but okay. I think at least both Pradeep and Abhijit are on the same page. A couple of people that I spoke to overnight as well said that it wasn't a move that was worth it. Let's wait and watch if it comes about or not. Thanks a lot for that, Abhijit. Thanks for joining in today and giving us your thoughts. Appreciate you taking the time out. Okay, before we dwell full tilt towards the equity markets, just a quick mention of the commodities as well. I thought that, a slew of data expected from China too today, Pradeep. That should probably keep the commodity space in focus?
Yeah, so right now, what is discounted in commodities in yesterday's trade is that the Chinese data may not be very strong, and therefore there was continued sell-off. In fact, if you look at the base metal index on LME, or you look at the positions that traders are taking on, Shanghai, they are all pointing at some kind of liquidation in positions, and the base metal index has declined by almost 4% on both the exchanges actually. But I think what would be most significant, is also the oil inventory number for oil, because once again we expect a decline, and that is why oil has gone above 64. So that could be one cause for concern. If oil holds above 70, and then we are talking about the Brent actually, if it holds above 70 and there is a breakout, that could be a big bad news for our markets. But the other important point to really watch out for amidst all this euphoria and induced short covering, so to say, what is very significant is what we mentioned 2 days back, that 90 is a very significant level for dollar index. It's holding on to it. Now it's inching towards 91. If it crosses 91, I expect further short covering by dollar bears. And if dollar establishes a kind of bottom, and it could very well rally up to 92.50 at least, and if that happens, you'll see some kind of long unwinding in various risk assets. So it is happening in commodities. Somehow it's not happening in equities, in emerging market equities that it happens. So at these levels, I think one should keep an eye on dollar index, and your stop loss levels. If you're going long, you'll have a stop loss level in Nifty, but I'll also keep a stop loss level of 91 on dollar index when I go long.
Well, if you go long, and remember, this is not a recommendation by any stretch of imagination, more an observation. Keep that at the back of your mind. However, since we are talking about commodities, let's start off our conversation with Parthiv Shah, who's director at TRACOM Stock Brokers, and joining us on the show with a commodity name. Parthiv, good morning. But what to do? Whenever I see you, I think of Tata Sponge and the fantastic recommendation, and now we have reason to talk about it. The numbers have come out. So let's start off with that. Then we'll move on to the bigger picture too. But what did you make of the numbers? I think the EBITDA margin expansion, very, very strong.
Good morning, Neeraj. Yes, Neeraj, absolutely. I think as per the expected lines, because what I mentioned about their cost metrics, they get a very high quality iron ore for producing the sponge, and especially the iron ore lumps from the Tata Steel iron ore mines, and it is very rich in the Fe content, and the quality of the sponge iron that they produce, they definitely tend to command a premium, and everything that they produce tends to get sold off. So I think it's a good time for these sponge iron players, and the efficient ones, I think they have a better cost metrics. So if I'm not wrong, the EBITDA margins were to the tune of around 23%, and I think Q3 realizations, what we saw on an average, I think Q3 to Q4, these have jumped up by almost 20%. So I think none of the input cost metrics have really changed a lot. So they're procuring coal from outside. Yes, coal has inched up, but the delta that they'll get in terms of the higher prices going into Q4 will, I think, definitely be even better than what they've seen in Q3. So I think between now and between Q4 results, I am assuming that, this stock might peak out. So again, I think, as I always mention, all these commodity plays, I think, have to be looked up on quarter-on-quarter basis. And if at all, I think this guy tends to reach around 1300, 1400 levels, I would definitely suggest to book out. The only reason being that currently they're operating at 100% capacity utilization. They do have plans for further capex, but steel capexes, as we know, can take forever, 3 to 4 years. So I think no point in trying to kind of predict 3-4 year kind of a cycle. But at least I think between now and between the Q4 end, I think probably one would get a chance to exit this counter.
Okay, so that's the call coming in. One most important query, I think, Parthiv, that everyone has top of the mind today is whether you advised your clients to buy into PSU banks yesterday, or whether you would like to do it today.
Very selectively, Pratik. I think it's a very long time amongst the PSU baskets. We've been advocating only 3 names, and that too all the 3 large names. So since a very long time, we've been advocating SBI, Bank of Baroda, and PNB. But more importantly, I think the only reason why we feel that these 3 big banks will tend to do well, because I think if I look into their even the stressful corporate loan book, I think there are looking a lot of chances of recovery. Just to give an example, Bank of Baroda, which took a company like Binani Cement into NCLT. Now we're hearing bidders quoting somewhere around 6,800 crores worth of bids, which is one of the highest. So I think there doesn't seem there'll be any sort of haircut. So probably the current valuations that these companies are quoting at, no doubt, I think one will definitely argue that the ROAs and the ROEs and all the metrics as compared to the private sector banks are a lot lower. But that is why they're quoting at 0.9 times price to book for FY19, FY20, it's even lower. So I think if at all we see any sort of faster resolution where the government is also very keen to get these banks cleaned up as soon as possible, and thanks to the yesterday's move of the borrowing number that we heard of, and many of these banks would have had a position when the G-Secs had moved up a lot to kind of cut down on their mark-to-market losses, bond losses. So that will give them some additional benefits. So that fear is also off the table. So I think we still believe that names like SBI, Bank of Baroda, I think they're quoting at abysmally low valuations. And if at all, I think one sees a couple of quarters of recovery wherein the stress levels tends to go down and the business performance tends to improve from all the operating metrics, I think we'll definitely see a re-rating, and even a re-rating from a low of 0.9 times price to book to around 1.4 to 1.5 price to book means a lot of money to be made, and still they will be cheap if they continue to improve on their performances. And just because of the PSU tag, they will be getting that 1.5, 1.6 type premium, not more than that. So even from here, there's a lot of money to be made, 50-60% upside. Which I feel is quite healthy in this.
Parthiv, so a short answer if I can. Other than SBI and BOB, is there a PSU bank that you would buy?
Not really. I think I don't have the guts to focus on the second tier PSU banks, Union Banks of the world, Bank of India's of the world. They can give good returns, Neeraj, no doubt about it. But from the best part of my understandability of these banks, I am still not confident what sort of dilution, what sort of problems they still face.
So for any bank that has an NPA of 25%, what you are actually buying is NPA. You are not buying bank because the capital is less than half compared to the NPA. So why would you buy it?
Well, just the point of that rising tide carrying all boats along with it. And I think the reason why probably all of us ask these questions to all these guests is because a lot of people, the common belief is that SBI and BOB itne bhag gaye hain. Let's look at some other banks jiski price kam hai. And I think that's the notion that we should dispel. Hopefully people are listening into this as well. Anyways, let's talk more about these and some other stocks with our research team as well. In fact, a clutch of names that are likely to react today based on the results and give you an indication of what a couple of companies could do in the quarterly numbers that will be declared today. Two nifty names, I think, Yes Bank as well as UltraTech. So let's start off with all of those and start off first though with Infratel. Sameet.
So the third quarter was an operationally strong quarter, but the outlook is weak for Bharti Infratel going forward. Now, the revenue was higher by around 7% to 3,655 crore rupees, and EBITDA was also up by around 8% to 1,600 crore rupees. On the margin front, it remained stable at 44%, and net profit was, however, down by around 6% to 585 crore rupees. Now, a net profit also didn't beat the analyst estimate. Now, this was because of an unusual finance cost of around 51 crore rupees in the third quarter and because of higher tax expense. Operational beat came in because of cost savings. Now, the revenue growth of 7% reported by the company was the lowest in the last 6 quarters, and the EBITDA growth of around 8% was the lowest in the last 8 quarters. Now, why the outlook is weak when it comes to Infratel is because in this quarter, and this is the first time since listing that the company has seen around 8,562 crore rupees, 62 tenancy losses on an absolute basis. Now, out of this 8,562 tenants, 5,600 still continue to pay rent in this quarter, and so the full impact of this tenancy loss will be seen in the next quarter, that is the fourth quarter of financial year 2018, and that's the reason why the outlook is weak when it comes to Bharti Infratel.
Thanks for that, Sameet. On to the other stocks in news, Darshan.
Yeah, so a couple of results that came out. Mindtree obviously will stand out in terms of its numbers today. If you're looking at the revenues were up 3%, that also on a quarter-on-quarter basis. Margins at close to 12% and profits up almost 13%. Two of the brokerages, Morgan Stanley has done a double upgrade on it, and Credit Suisse has raised the target price. So pretty much should be a stock of the day. Thirumalai Chemicals, again, the strong run continues. Revenues up almost 40%, profit up almost 240%, and margins at 23% versus 16% last time around, so extremely strong set of numbers. Even Adani Transmission came out with a strong set of numbers. Revenues up almost 150%, EBITDA margins at 80.6% versus 65%. Somehow mixed set of cues from DCB Bank, not the best. Even though NII was up almost 20% and PAT up 12%, the asset quality seems to have deteriorated slightly, so not the best number. So I would say it's an inline set of numbers. Axis Bank has increased the MCLR by 5 basis points across tenor, should be positive, and Deutsche Bank has indicated that Marico has increased prices of parachute coconut oil by 8%, so that will be in focus. Confidence Petro, Purinju's fund has bought in almost 1.2% stake in the company, and interesting, L&T Mutual Fund has bought in 6% stake in Imami Paper Mills, so that will be interesting to watch.
Wow, a clutch of small names as well, and some very good results that have come out. Thanks for that, Darshan. A couple of previews, and let's start off, Shraddha, with Yes Bank. What's expected?
Just a quick recap of what happened last quarter, because that was very important. The stock has actually tanked, and gross NPAs, slippages, all those numbers had spiked, and that was because of the disclosure on divergence for FY17 numbers, where the gross NPA divergence stood at 6,300 crores. That actually led to some sort of trust deficit, but having said that, there was some comfort that came in on the back of the strong resolution capability, because that 6,300 as of March 17 had come down to 1,200 crores as of September 17. With respect to the NCLT exposures, the bank has already provided for about 50% to list 1 exposures and about 39% to the list 2 exposures. So with that backdrop, what do we expect in this quarter? Well, operationally, it should be a steady performance that should continue. Net interest income seen growing by 28%, net profit at a slightly lower 20% on account of higher provision. Net interest margins to remain stable, loan growth seen at 30%, and when it comes to asset quality, there's no big negative surprise expected this quarter. All the analysts that I spoke to said actually that whatever had to happen probably in Q2 has already happened, and in this quarter you could in fact see some recoveries coming in from those divergences. So broadly, analysts will be watching out for asset quality trends, any revision as far as the credit cost guidance is concerned, and any sort of traction in CASA and operating profit that should continue, but largely we need to see that asset quality issues were one-off or not.
Okay, we'll watch out for that, as we'll watch out for UltraTech. Nikki?
We are expecting a muted sort of quarters, at least in terms of the operational performance. And if you look at the bottom line, we're expecting a dip out there at least 24% year on year. If you look at the top line growth, we're expecting a number of 27% at a number of more than 7,000 odd crore. EBITDA is expected to be at 20% higher at 1,340 odd crore. Margins are expected to be stable. Volume growth is expected to be, that's a key number. We're expecting a 22% year on year growth in this number at a number of around 13.9 MT. Strip that off, strip JPA assets volume off, then you would see a 8% incremental growth coming in. We are expecting a decline in EBITDA per ton, a number of around 965 odd per ton is what you can look at. Higher energy cost along with your consolidation of JPA assets is expected to weigh on the profitability, and also the finance cost and the depreciation. In terms of key things that we'd like to watch out will be your outlook, demand and pricing scenario, and importantly, the capacity utilization of JPA assets going forward in this quarter.
Thanks. We'll watch out for both of these, as also we'll watch out for Airtel, as Sameet had said in first word too. So that's a key number to watch out for. Thanks all of you for joining in today and giving us those perspectives. Parthiv, clutch of names that we can talk about. We discussed HUL at the start of the show with amongst ourselves, and then a clutch of others like Mindtree too. Let's start off with HUL. What do you expect the stock to do? Because the commentary, if it's to be believed, is robust, not just for the quarter gone by, but also for the quarters ahead.
One very important point, Neeraj, that I kind of took from the management commentary is still the rural growth is not firing on all cylinders, which means that without that, if they can deliver volume growth, no doubt, I mean, we must admit that because of the favorable demonetization base and the GST 10% tax cuts for almost 54% of their revenue base, they had huge tailwinds in this quarter, and despite the analysts factoring in the tailwinds and the volume growth estimates at 8 to 9%, they delivered 11%. And their GTM strategy, the go-to-market strategy, is I think one of the best one can find in this country. And I think even the premiumization focus, especially coming out with smaller sachet size in the premiumization products, the Ayush launch, all of this did not dent their cost metrics, and they came out with fantastic margin numbers. So this shows the quality and the pedigree of the management that they are having. And I think going ahead with even rural picking up, I think probably we'll see fantastic numbers going ahead. And I think if I have to talk of FY19, FY20 times, it's quoting at around 45 to 50 times price to earning multiple. But I think such companies with such fantastic ROEs and return ratios, I think they definitely tend to justify. And I think if one is having in the portfolio, just forget over it. And if one wants to add on to these levels, if one has a view of next 5 to 10 years, I think it's a no-brainer add also for me from these levels.
Okay, Parthiv, just one question. You know what everybody is mentioning and every report is writing about, that last year, same quarter, there was a negative growth and therefore you get the 11% number. When you adjust it and normalize it, what is that normal number that you will pencil in when you make projections for coming quarters?
Absolutely, Pradeep. I think on a normalized quarter, any volume growth between 6 to 8% is something where I'll be very comfortable assuming that, you know, they are getting their mojo back. And I think, again, the rural aspect is extremely important because I think more than the urban, I think demonetization and things like GST had a bigger impact in the rural segment. The destocking element that we talk of coming with GST had a bigger impact in the rural segment, but that will tend to normalize even further in Q4. And especially with the 10% tax cuts, along with the fact that the management is not in the mode of anti-profiteering, they are rather working on their cost metrics and wanting to pass on those benefits to the consumers. I think the alpha that we'll see, especially in the rural segment with these price cuts and the volume growth, I think that's what is keeping me very confident about HUL's story going ahead.
Okay, so when it comes to, you know, market moving metrics, what I've observed is, you know, volume growth is for HUL, what NPA is for a PNB. So I think this is a big positive, isn't it?
Yeah, it is. Well, watch out. You know, and Parthiv is talking about the rural commentary, but I just took into account the commentary that they made for overall demand, and they said that the demand looks strong and sustainable is the term that they put in. So overall, I take on board Parthiv's comments, but I thought their point on sustainable demand going ahead was pretty interesting. Let's wait and watch what happens in the quarters ahead. Should react positively today, I would presume. That's the long and short of it. Anyways, 8:50. Before we get in our technical experts on board then, and I'm sure Sameet, Chouhan and I think Shrikant are with us. But let's first talk about Bloomberg Edge, our special segment, because it's that time of the show when we do that. Jayesh Kilnani joins in to tell us about a pattern that the terminal has thrown up on a stock. Jayesh, what is the stock on the radar today?
Morning, Neeraj. I'm watching out for Hindalco. That is because there's a possibility of early buy setup indicated by the stochastic indicator. Now, first, let's look at what the stochastic is and how you need to decode it. It helps you to identify when a price move is actually overextended. So it measures where the current price is in context to the recent high or the recent low that the stock has clocked for itself. Few conditions that you have to keep in mind. So overbought is above 80 and oversold is below 20, and there are two lines which get plotted. Crossover between the two lines gives you a buy or a sell signal depending on the direction of the crossover. And now going to the chart of Hindalco, we have seen that the stock has been on a steady decline, and candle session number 7 has been recorded. So possible turns happen at about 8, 10 or 13 as per theory. So we are very close to that candle number 8 mark that is in the candle sessions. Now the bottom panel shows you the stochastic indicator, and if we zoom into this, we can see that the blue line has crossed above the white line, but both of them are still below the green line, which gives you a possible early indication. Once both of these lines cross above the green line, that is where your confirmation of buy signal will come in.
Okay, we will watch out for these. Thanks a lot for that, Jayesh. So do watch out for Hindalco stochastics. There's an early buy setup that is being formed. Let's talk technicals with both our experts. Sameet, Chouhan and Shrikant Chouhan join in with their sense of the chart. Gentlemen, good morning to both of you. Thanks so much for joining in. Sameet, a quick thought on if there is a trade on any of the key indices, the Nifty Bank, or any of the other key indices.
Hi Neeraj, it will be very difficult to take this call right now, but if we see overall Nifty's price action, it's been moving in a range of 150 points, and yesterday we saw massive recovery from lower levels, and today as the HX Nifty is suggesting, it is likely to open with a upside gap. So it becomes very difficult to take any particular call right now. One should wait for first half an hour or 1 hour closing, and if prices stabilizes about 10,820, then probably one can take a buy call. But as of now, I would avoid taking any particular call on index. Rather, one should focus on individual stocks.
Okay, Shrikant, is that, and that's your call too? It could be different from Sameet's, but what is your sense on the index trade?
Good morning, Neeraj. I think, see, the way yesterday the market closed and the way the Bank Nifty is trending, it closed above the mark of 26,000, and if you go through with its pattern, of last few weeks or few months, then it was like consolidating below the mark of 25,950, and it was not ready to cross these levels in spite of like there was a positive news on the Gujarat election side. So it was like consolidating, and after like consolidation of a few months, the Bank Nifty has broken this level yesterday with good volumes and along with participation from PSU banks. Bond yield also has fallen to the 7.20 or 25 levels. So all this positive news flow clearly indicating us that Bank Nifty is heading for 27,000, which is like still 700-800 points higher from current levels. And Bank Nifty is always supports to the Nifty. So I am of the view that even at this price also, if Nifty is opening at 10,850, 10,835, we should look for taking long positions, because I am not now expecting market to trade below the mark of 10,750. So 10,750 should be your stop loss, and we should look for taking long positions, because from here also Nifty can go up to 10,950, 940 along with the trend of Nifty. Even if you go through with the trend of other indices like capital goods or IT, there also a lot of activity and a lot of momentum is there. Auto stocks have corrected to their important supports like Maruti, Hero Motors, Bajaj Auto. They can also like participate if there is a reversal in the market. So net even at this price also, we are of the view that we should look for taking some long position in the market at the opening.
10,925 is the level that Abhijit Phatak was talking about. Shrikant is telling us 10,940, 950. So that could be a target range now for anybody who is entering into the market at current levels with a stop loss for sure. Sameet, which stocks would you like to trade today?
First one would be from pharma space, Sun Pharma. We have been liking this stock, however the stock has been consolidating in the range, but somewhere around 575 we are seeing a strong support, and yesterday we saw recovery from those levels. So we would go long in Sun Pharma for a target of 608. Stop loss would be around 568. Our second buy would be on DCB. Recently we saw a breakout from triangular pattern. Post this we saw some kind of consolidation, and since last couple of days the stock has been correcting. But yesterday we saw recovery from its previous breakout points. So going ahead, we expect DCB to move higher. 204 is our near-term target. It can be bought with a stop loss of 189.5. And a solitary sell call would be on Apollo Hospital. Despite market making new highs yesterday, we saw this particular stock breaking its important support level, which was around 1140, and has managed to close with a cut of nearly 2%. So we would expect some kind of weakness to continue in this stock. Stop loss at 1153. Target would be around 1080.
What about you, Shrikant? Your trading ideas?
Neeraj, we like KTK Bank, and if you go through with its monthly pattern, then it was below the level of 150, 145 for several years from 2008 to almost 2017. And after breaking this level, now the stock was like just like consolidating above the breakout level. So from here, based on news flow and based on price pattern, we are of the view that it is heading for at least 178, 180 in the near term. So that is what the target for the day. But if there is a view of next few weeks or few months, then I'm of the view that it is heading for minimum 225, 230. So it's a strong buy at this price with a stop loss at close to 157, 155. The other one which we like from the PSU space is Punjab National Bank, which is trading around 175. Yesterday also there was a good amount of activity and close to 30-35% kind of delivery based volume. Whenever there was like activity in the stock in the past also, after this recap announcement, most of the time whenever there was a volume based activity, we saw good amount of delivery based activity. So this clearly indicating us that the stock is again heading for minimum 200 plus kind of levels. Today again it is going to open up with a gap of maybe 10%, 5%. But even at those levels also one can look for taking some long position, because finally the stock is going to surpass its previous high of 230. But in the near term, our target is close to 200. So with a stop loss at 165, 167, one can look for taking long position in PNB.
Okay. Parthiv, just one thought on arguably the stock of the morning, Mindtree. Extremely strong performance, but has had a bit of a run up. How much more in store, fundamentally?
Yes, Neeraj, I think post the buyback and I think especially after the market saw that both the acquisitions that they had done, they are now kind of turning around and adding to the numbers. I think Mindtree has had a very good run up, and Mindville, I think this as a mid-cap IT stock as compared to many of its mid-cap IT peers is, I think, slightly expensive and quoting at a slight premium. But it deserves that, the only reason being, especially what we all talk about again and again for the IT sector, is the foray in the digital segment. If I have to compare a larger peer, TCS, which is continuously winning new and new orders, and all these orders are coming in the higher margin, the better business pie, which is the digital segment, where they had done a lot of capex in the past. A very similar story is happening in Mindtree, where on a relatively very smaller scale, they had continuously focused on investing in the digital foray, and probably that is one of the reasons why their past margin levels of 18-20% had come down to as low as 11-12%, and now looking like they're tending to improve. So I think I'll be keenly watching from here at these valuations how the upcoming quarters pan out, especially in terms of what is their pie of the digital business that they're obtaining, because that will come at a higher margin, that will give more sustainability and visibility towards the growth. So I think that will be the key element. But for now, it seems, I think, a lot of good news is baked into Mindtree, and today maybe I think there could be some positive reaction, but I think it should hover near around these levels.
Okay, so that's the call on IT. Let's see how Mindtree performs. There is a double upgrade, I think, from Morgan, and that would also work on this stock like it has worked on heavyweights like ICICI. So if Morgan's call can move ICICI so much, what happens to Mindtree? That is what I'll be watching out for. But let's see what's the signal this morning. 10,848, almost 10,850 odd levels, where probably index could start the day with a strong gap up with all the Asian markets in the green. This picture is completely different from what we had seen yesterday in the morning, same time. Let's see what are the early quotes coming in. 10,784, 11,126.
That ain't happening.
No, this is my target for 2018. It will definitely happen in 2018. Well, let's wait. Sensex up 700 points. That's okay. There will be a gap up, but will it be this big a gap? Unlikely, but let's see what's happening in some of the heavyweights and what's really driving the markets up. Look at SBI, Axis Bank, HUL, HDFC Bank, HDFC, ICICI Bank, and Yes Bank. All these are up by 10%. All 10%.
Yeah, let's wait. Let's wait for these rates to settle down a bit. Let's look at some newsmakers. Let's look at HUL. And see what HUL is doing. I mean,
it's also 10%.
No, yeah. So there's just a lot of buoyancy. Again, remember, I think the Nifty pre-open rates take into account maybe some traders who are happy-go-lucky on the belief that those FD limits will be raised. Let's wait and watch this. There could be a lot of time between when and if that happens. So let's not really bet on that. Let's look at the newsmakers. HUL. May not be 7%, but certainly could have a start in the green. Mindtree is the other one. Adani Transmission is one more, as well as Thirumalai Chemicals. I don't know about a 6.5%, but there will be gains there. Adani Transmission, extremely strong margin performance, as also with Thirumalai. Maybe not as strong as the other two, but very strong quarter. I think the profits have doubled for Thirumalai Chemicals, and this too should have a day in the green. Fundamentally, irrespective of the market mood, it promises to be a day in the green for a lot of these names, simply because of the news flow around it. And then just watch out for two small caps. One of them is Emami Paper. L&T Mutual Fund has bought some stake there. I don't know if Emami Paper will be trading so early, but let's wait and let's see if that one is. And the second one is Confidence Petroleum. Emami Paper 6.5. That seems to be the order of the day. Nothing below 5%. Confidence Petroleum, Equity India, which is Puri Jeweller's firm, has bought some stake. It's a tiny tune, keep that in mind. But that stock is starting off 10% higher too. But yeah, I think Pradeep is right. It's more about what's happening to banks. A lot of others will move. But yeah, banks are showing some strength right now.
So we don't know how the Nifty Bank will settle. We'll have to wait for that and then see what happens next. But all these banks are probably going to open with a gap. Well, Nifty is now coming down. It's below 11,000, but still 10,960. I think it will settle further, and we'll probably wait for it. But there's one question: if all these names that you could maybe call pro-cyclicals start to move up, IT was a nice place to hide. Shrikant, I don't doubt the medium to long-term trend on it, and all the charts are also indicating a long-term breakouts for IT names. But for a tactical trader, do you think this time to book profit? Because everything else is moving up, and there could be some rotation of positions.
See, I think it is the way the formations are there. I think one thing is very, very clear that after a very long period of time, they are coming out of their price breakouts. Like HCL Technologies was like up by almost 4-5% in a day. Wipro has broken its all-time highest closing on a monthly basis. So all this indicates that there is also like a lot of funds which are like taking interest. And based on that, certainly like we should look for taking long position instead of like exiting or taking some profit and all, because TCS is into new highs. Wipro is going to do extremely well in the near future. That is what is our view. Mid-cap IT like Sonata Software, Persistent, Mindtree, which has delivered good numbers. I think all these stocks are showing a lot of momentum, and I am of the view that now this is what the trend or maybe the scenario of the market where all the sectors are going to do well. So it is better if we buy stocks like Mindtree or Persistence, which have underperformed in the near past, and they are going to do well in the near future.
Okay. Let's wait and watch. But yeah, there is earnings and commentary which is backing this move as well. Keep that in mind. They may have been a pockets too high, as Pradeep rightly said, at the first half of calendar year 17. But the second half has been extremely strong for most of these. Anyways, more on that in a bit. First, get in Sameet Sarkar, who is joining us with the big brokerage calls for the morning. Sameet, good morning.
Good morning, Neeraj. On the big brokerage calls for the morning, first we have is UBS Securities on small finance banks. Now, they're expecting the small finance bank to report the highest loan book and revenue growth in the next 4 to 5 years. Now, they have initiated coverage on 3 small finance banks, that is AU Small Finance, Equitas Holdings, and Ujjivan Financial Services. And according to the brokerage, the loan book of these 3 small finance banks is expected to grow 4-fold over FY17 to FY22 to 95,200 crore rupees. It is also expecting the revenue of the small finance bank to grow at a compounded annual growth rate of 29% over FY17 to FY22. Now, they believe that the valuations are now attractive for Equitas and Ujjivan, and though AU Small Finance Bank has the best metrics, the valuations are expensive for the bank. Now, AU Small Finance Bank and Equitas are better placed for loan growth because of the diversified product portfolio, and the MSME segment provides a good large opportunity for these small finance banks going forward. Now, on Equitas and Ujjivan, they have initiated a buy rating with a target price of 250 and 575, and on AU Small Finance Bank, they have initiated coverage with a neutral rating and a target price of 800. Second, we have is Axis Capital on Sterlite Technologies. Now, they have initiated coverage on the stock with a buy rating and a target price of 430. Now, Sterlite is expected to benefit from a multi-year global data wave. Now, exponential increase in data consumption, unavoidable replacement of copper wire with optic fiber wire because of the demanding requirement of infrastructure, transition to 5G, and government initiatives are the positives and will drive growth for Sterlite Technologies going forward. Now, the shift towards optic fiber is inevitable according to the brokerage, and they're expecting the domestic demand to accelerate given the fact that India has the second largest internet usage and the lowest fiber to population ratio globally. Now, they're expecting the company's revenue and EBITDA to grow at a compounded annual growth rate of 20% and 25% over FY18 to FY20. And lastly, the brokerage says that Sterlite has a meaningful moat, being one of the only 8 integrated optic fiber player globally, and should command a scarcity premium in the market, which has a good long-term potential growth.
Okay, thanks a lot for that, Sameet. Now, here's the interesting stock, which is Adani Transmission. It's up about 8.5% in the first 7 minutes. Maybe this will change as well. Let's wait and watch. But it's showing good traction here. Parthiv, Adani Transmission, very strong numbers. It's now got a large Mumbai-based asset as well, but it is an expensive stock, I would presume, fundamentally. What does one do here? For somebody who's holding the stock, what's the advice?
I would continue to hold. See, frankly, I think these numbers are not really comparable year on year because of all the inorganic acquisitions that they've done. But I think this is, as a company, building up a fantastic franchisee of a very good long-term annuity potential kind of a stock and a company. And I think they have done a tremendous job in terms of inorganically and even, I think, organic growth. And I think these are something which are not easily replicable by the peers orders by the competitors. As a matter of fact, I'm surprised at the pace of growth that Adani Transmission has shown vis-a-vis, I think, the first mover in the private segment, which is Sterlite Grid. In fact, Sterlite Grid was the one which had initially won 3 major projects for huge kilometers of circuit line. And I think Adani Transmission, with the inorganic strategy, the organic growth, they've surpassed them. So I think after Power Grid, which is still a monopoly and will stay that way for quite some time, the best thing about this sector is that the government has opened up for the private sector. So I think unless and until the government does not intervene or the regulator does not intervene in terms of any sort of cap on the tariffs or kind of reduction on tariffs from the current levels, which I really doubt they would, because these are the companies which are continuously investing in newer assets. So in that case, I think over the next 3 to 5 years, I don't see a reason what could disrupt this story. And I think players like Adani Transmission, though they look expensive at the face of it, but the way they are growing, the way the aggression that has been shown by them, maintaining the balance sheet quality in terms of the assets delivering cash flows, I think it's a good story to hold on for the existing shareholders over the next 3 to 5 years.
Okay. Sameet, as the pre-open rates have settled, certainly seems to be the case that banks will start off on a good note. I appreciate you don't want to take a trade on the index. What about State Bank of India, Sameet?
See, SBI certainly looks good. If we see overall price action in last couple of months, the stock has been gradually declining. And yesterday we saw recovery precisely from the levels of 200-day moving average. And as a disclosure, we have recommended this to a client, but in call option segment. So we remain a bit. 310 call option was quite active, and from here on also we believe that it will have a good appreciation. But around 325, 330, the stock has immediate resistance. So one should look out for these levels at least for near term.
Life highs for ICICI Bank, life highs for Axis Bank, life highs for HDFC Bank, Yes Bank ahead of results at life highs. It's just robust banking stock environment to be in. Any which ways, we'll talk more about this and with Parthiv too. He's, of course, remember, for the benefit of our viewers who are tuning in right now, Parthiv Shah of TRACOM believes that you should probably buy into SBI and BOB at best. Don't go out and venture in some of the other names. At least he's not going out and doing that. Anyways, 5 minutes away from trade. Let's tell you all that you need to know to stay ahead in the session today. Adani Port SEZ, Bharti Airtel, UltraTech Cement and Yes Bank are the numbers slated to come out today.
And HUL meets BQ estimates. Hindustan Unilever's 11% year-on-year volume growth surprises most analysts.
Bharti Infratel, Mindtree, Thirumalai Chemicals, as well as Adani Transmission report strong set of numbers. DCB comes out with a mixed bag.
Coming to the initiations today, UBS initiates coverage on Equitas with the price target of 250 rupees per share, on Ujjivan with the price target of 575 rupees per share, and on AU Small Bank with the price target of 800 rupees per share, and Edelweiss initiates coverage on Magma FinCorp with the price target of 238 rupees per share.
Porinjo's Equity India Fund buys into Confidence Petroleum, the stock starting off 10% higher. L&T Mutual Fund buys into Emami Paper Mills, and that stock too starting off 4% higher.
GMR Infra, HDIL enter FNO ban, while Jet Airways, RCOM and Wockhardt exit. So a lot of action. Actually, if you look at the key movers today, you have financials and you have IT. These are the two sectors leading. If you look at the Nifty 500 or whichever way you slice and dice the data today, these are two segments, but a lot of action on Small Finance Bank and then NBFCs, several positive reports coming in. Parthiv, if you had to pick up just one name from this segment, a small bank or say an NBFC, what's your choice?
See, I think my choice in the small finance bank would be Equitas. The one thing that I like about Equitas is that they had very consciously decided not to expand or not to grow as a part of the overall kitty in microfinance. And I think that conscious decision will separate them apart as compared to many of the MFI plays. And I think they're really focused on the used CV segment where there's a lot of competition. And I think the current MD, I think he has a lot of pedigree in that experience. especially in terms of the use of CV vehicle financing. And that's a very high yielding business, which if kind of handled well, can give very good dividends. So I think they have a reasonably good secured book, and I think they are focusing on the other verticals, which are good in terms of the ROEs. And no doubt, I think the current cost to income metrics won't really look good because they're currently in an expanding phase. But I think come 1 or 2 years down the line, that will tend to improve, which will really enhance the return ratios, especially the ROAs. So Equitas over the next 3 to 5 years, yes, I think it's a very good story. If I have to talk about NBFCs, I think at one point in time, Capital First was one of my favorites, but I think now the commentary has totally changed after the merger and it's become a more longer term story. But I think I'm looking forward to numbers from L&T Finance Holding. This has been an old favorite, which has delivered well on numbers, and the razor sharp focus of the management in trying to deliver 18-19% ROEs, improving cost to income ratio quarter on quarter, focusing on the right verticals, I think makes me really upbeat on this stock, especially after the recent correction from 210 levels to current 170 levels.
Okay. Well, let's wait and watch there. But a minute and a half left. Stay on, Parthiv. Let's get in the top ideas from both our technical experts for the day. And Shrikant, if you had to bet on one stock for the morning, which one would that be?
Yeah, I would like to go with KTK Bank, which is around 160 to 163 levels, and here we have a bullish view. We are expecting 175, 180 as a target, which is almost 10% kind of upside from current levels. So it's a buy at these levels with a stop loss at 157. But based on the result and all, we also like Mindtree as well as Ujjivan.
Just one stock, Shrikant. And Sameet, what's your topic?
I'll stay with DCB. The overall chart structure looks quite encouraging, and the stock has rebounded from its important support level. So I'll stay with the DCB, target 204 to 206. Stop loss would be around 118.5.
Yeah, that's what I'm saying. It's actually turning out to be a day for banks. Let's wait and watch. From a trade perspective too, it's all banks that our trading friends are recommending for the day today. So important recommendations: DCB and Karnataka Bank from Sameet Chavan and Shrikant Chouhan. So keep those at the back of your mind. But here are the first trades this Thursday morning, and we'll start off in the green. The question mark is how much further can we go? The Sensex all set to start almost 1% higher in trade. That's a very strong move, 1%, 350 and 10,877 for the Nifty. Boy, are we in for a ride the last few days. The Nifty Bank, the predominant contributor, up about 2.5%. Let's very quickly get in the Nifty heat map and just see what is moving around. I would presume SBI and some of the private banks are taking center stage here, yes? So SBI, look at that. SBI, HDFC Bank, ICICI, Yes Bank. There is Axis too, and IndusInd far out there. Kotak Mahindra Bank about 1.25%. The top row of the gainers dominated by what's happening to banks today. So banks are clearly setting the stage for the move. Let's wait and watch if this lasts or not. For now, there is momentum in the banking space today. NBFCs too, the likes of HDFC are participating. And more importantly, there aren't enough losers. There is a small loss in Bharti Infratel, but that's a tiny tune in weightage. At the far corner, Bharti Infratel is down. But aside of that, I don't think there are too many losers. Reliance maybe 0.5%. IT is taking a bit of a backseat today. But banks are right up there and going very, very strong for now. Let's wait and watch if that lasts or not. A few stocks that I want to mention very quickly before I hand it over to Pradeep. And let's bring up the list of stocks which have come out with good results. So Mindtree, 7%. Thirumalai Chemicals, 8%. Adani Transmission, 5%. All three have a common theme, which is margin expansion. On Mindtree, remember, there's a double overweight as well by Morgan Stanley. Morgan Stanley. Credit Suisse has come out with a note as well. 8% now for Mindtree. Really good going for this stock. What else? There's a UBS note on all small finance banks, and all three start off very, very well. Maybe AU not so much, but Ujjivan and Equitas certainly doing very well for themselves. There are a couple of other names. Confidence Petroleum, an Equity India fund, has bought stake. It's a tiny tune, but up about 10% in trade. Last but not the least, aside of this one, Emami Paper Mills, where L&T Mutual Fund has bought some stake, and that stock is starting off 2.5% higher. Pradeep, what else?
So you have Gallant Spark, though numbers came 2 or 3 days back, but the up move continues here. Kokuyo Camelin is another name, up by around 6%. You have Orient Green Power doing well. And you also have Renaissance Jewelry, Jammu Kashmir Bank. And why is Dhanlakshmi Bank up 7.5%? I seriously don't know. This is a big underperformer for several quarters now. Goa Carbon is another name which is doing well. Magma FinCorp, again with a positive report from Edelweiss, is helping this one move up. But when people are buying into banks, NBFCs and IT, what are they selling? GVK Power is down 4.5%, not locked at lower circuit as yet. TV Today, that moved up over last few days, is down by around 2.5%. Also, you have Shreyas Shipping, which has fallen today. Aarti Drugs, GAIL is down today after yesterday's smart move. Sugar stocks are not doing well either. Shankara Building, well, it recovered from the day's low, but still down by 1.5%.
Okay. Quick thoughts from our experts. Sameet, anything that pops up on your screen which excites you?
See, Vocard certainly looks good. After seeing a massive rally, it has corrected since last couple of weeks. And yesterday we saw a recovery precisely from its important supports of 900. And today also we are seeing good positive traction. So I would go with Vocard, and I would recommend this stock. We expect this stock to head higher. 1,000, 1,020, these are the next levels to watch out for.
Shrikant, what about you? Anything that pops up on your screen?
I think, see, real estate stocks always participates whenever there is activity or momentum in the market. This time also, when there is a momentum, we are expecting India Bull real estate to participate. Currently, it is around 243, 245 levels. Yesterday also, when it was down 230, from there it recovered all the way to 240. So it's a reversal formation after hitting the levels of 265. So here we have a bullish view, and we can look for taking long position in India Bull real estate at current levels, 243, 245, with the stop loss at 237, and we can keep a target of close to 270 again.
Okay, just a bit of a, maybe a bit of a pullback, but still in the green. So good going really for almost all of those names. Fair call. Take a moment to thank all of you. Parthiv would have chatted more, but we're just running out of time on the show. Thank you so much for joining us. Shrikant, Sameet, thank you so much for joining us as well on the show today and giving us your thoughts. The broader markets too, fairly active with Mindtree ruling the roost. Some of the others have cooled off, the likes of Adani Transmission, etc. But the going is good. Varun Beverages, incidentally, on winning that Bihar state from for PepsiCo franchisee is about 3.5% too. But let's talk about where the markets move on from where they are currently. 10,857 are heady levels. Let's talk about all of that and more with Manishi Raychaudhuri. He's Asia Pacific equity strategist at BNP, joins us on the show. Manishi, good having you. Thanks so much for taking the time out.
Thank you very much.
I think your India head of research, if I'm not wrong, in a note recently to Bloomberg, put out a note saying that while we all talk about the heady levels, if we compare to the Indian indices to the Asia Pacific region, on a relative basis, the premiums are not as high.
Yeah.
You would believe there is room.
In fact, you know, that's a very interesting point. Notice 2017, India, despite this heady rally of about 35%, actually underperformed MSCI Asia ex Japan. In that year, China, MSCI China moved up about 55%. Korea, both KOSPI and MSCI Korea moved up close to 45 to 47%. So India, despite this massive rally, was actually underperforming, and therefore it turned a little cheaper compared to its peers from the beginning of the year to the end of the year. We believe that, yes, I mean, India continues to trade at a premium that's possibly a little less than one standard deviation above the mean, the long-term mean today, which means that, yes, the premium exists, but it's possibly not egregious. Now, having said this, I must sound a bit of cautionary note at this point of time. In the other parts of Asia, particularly North Asia, this massive rally has been underpinned by strong fundamentals, which have translated into earnings estimate increases. Asia ex Japan, consensus EPS moved up about 15 to 20% last year, driven largely by Korea, by Chinese financials and Chinese tech. Now, Chinese financials joined in towards the end of the year. India, in contrast, has drifted down throughout the year, Indian EPS estimates. So, for this rally to continue, for this rally to become stronger, we would need to see a reflection in the consensus earnings estimates for India, which haven't reacted till now, you know, except for a few small pockets like materials. You know, the metal companies have been doing well, etc. But we need to see that get a little more broad-based.
So that low growth period is probably behind us, because if you look at some of the recent indicators, like what's happening to PMI or one surprise number we got on IIP also, and then look at the volume growth number from HUL. I think there could be upside surprises in growth and earnings in 2018. Do you think so?
I agree with your point that the low growth period is behind us. If you look at GDP growth, both real and nominal, last 2 or 3 quarters were clearly influenced by the twin icebergs of demonetization and implementation of GST, close on the heels of each other. But at the same time, these measures have a long-term positive impact, which I think we would begin to see from now on. They're also reflected in some of the on-the-ground variables that we track closely, in terms of cement sales, in terms of construction activity, in terms of auto sales and two-wheeler sales, etc. So I'm actually, positive on that front. I think that the growth slowdown that we had seen over the last 2 or 3 quarters, it's actually beginning to revive. The most recent IIP data is actually a case in point. And I think that both in terms of real and nominal GDP, we were likely to see a reflection of that in fiscal 2019, and which should translate into earnings growth recovery as well.
Manishi, so one is what HUL has done, and those were the stable names. I think what's also looking like changing is the underperforming 2017 spaces, and IT is probably one.
Right.
PSU banks, if at all, they do get the recap and therefore growth, could be the other one. Could 2018 be the story of some of the underperformers starting to make a contribution as well?
You see, in December, when we published our outlook report for 2018, this is a point that we made strongly. We said that yes, in 2018, investors should actively consider looking at the good quality underperformers of 2017. Now, in the Asian region, you have quite a few of them, particularly in the material side, and the chemical companies across North Asia and Taiwan, Korea, which underperformed. But at the same time, the valuations are cheap and the fundamentals seem to be strong in terms of the chemical margin sustaining. In India, there are a couple of examples that you cited. IT is one of them. We continue to we continue to have exposure to Indian IT in our model portfolio. The public sector banks, we are a little more circumspect about, because we think that this whole movement towards recognition and resolution of the NPLs, that is obviously a great thing, great development for the PSU banks. We will have to watch out for some of these assets which are coming in for bidding, over the next couple of weeks. We also have to watch out for whether those assets actually get transferred to other private sector owners successfully. And for that, I think we need another 3 months or so to figure that out. But
you have any doubts, any impediments that you see?
Well, not really, but it's like, what kind of valuations the private sector companies are willing to bid for these. That is an important variable. Whether the actual transfer of ownership happens in a smooth manner, that is another point to look at. So, I think the recognition part has happened, driven by both the Reserve Bank of India and the government. Now we are in the resolution part, and the third phase is reconstruction.
Okay, fair call. But I just wanted to take the second part of that question as well, which is IT. You mentioned you have a small exposure.
Right.
Is your IT exposure in your model portfolio equal to the market weight that IT carries in India? Or is it still underweight?
It is still
relatively underweight.
It is still underweight. We like the tech space across Asia, but we're clearly more positive on the Taiwanese, Korean, or the Chinese internet companies, because they are being driven both by global consumption demand and regional consumption boom that we're seeing. Particularly across North Asia, but in pockets of Southeast Asia as well. In contrast, Indian IT is a different business. It's a B2B business, which is also influenced to a large extent by, what kind of import-related policies that we have in developed markets. It's also influenced by, this whole trend, which is making the manpower cost arbitrage model obviated nowadays, necessary. It's being taken up by artificial intelligence to a large extent. So many of these companies would have to reinvent their business going forward. Some are doing it, but it's a space that we have to watch out very closely.
So the other segment that you were talking about, banking, if you have to pick up today, how does this rising bond yield really affect various players, PSU Bank, private banks and NBFCs?
Right.
And which one would probably get hurt least and therefore should be preferred now?
Well, I mean, one thing is obvious. If I look at the bond yield, bond ownership, or the government bond ownership, the PSU banks obviously have a lot more of those. Yeah. So, if the bond yields move up and therefore the prices decline, on a mark-to-market basis, they would possibly tend to lose out more than their private sector counterparts. Now, having said that, I also understand that many of those banks have moved significantly to held to maturity model as far as the government bonds are concerned. So the impact may not be all that much. In the banking space, we are actually more positive on the private sector banks, particularly those which are retail focused. Not so much the corporate lending focused private sector banks, but the retailers, which is a stance that we have maintained for more than a year now. And at least right now, there's no change to that particular allocation.
Okay, I have a related question here. When we talked about the valuation premium that India commands right now, the most obvious explanation has been look at the interest rate, and since interest rates are low, peak and rise. But which interest rate? If you're looking at Indian 10-year bond yield at 7.5, we are probably at the long-term average, if I'm not wrong. Yeah. So your valuation should also be there. Or are you looking at the US bond yield, which is 50% of the historical average? What does really matter for us if I'm holding on to a stock for the long term?
Right. So basically, if you look at the key valuation-related variables that we look at, price earnings or price to book, they are driven. So price earnings, as Economics 101 would tell us, it's driven by future earnings growth. And growth in an economy is also correlated with the prevalent interest rate. So India has relatively higher interest rates in terms of the bond yields because growth is higher or supposed to be higher, right, than the rest of the world. Now, over the last couple of years, maybe over the last 1 year or 1.5 years, that hasn't exactly borne out in the way it should be. Global growth recovered in the second half of 2017 nicely. India did not participate. Now, of course, as I said, that there were policy-related disruptions that India suffered from, and these policies over the long term should actually accentuate growth rather than depressing it, which is possibly what we're stepping into now.
So you think the higher bond yields are actually pricing in anticipation of higher growth?
Absolutely.
Okay.
Yeah. Anticipation of higher growth, maybe slightly higher inflation than we are seeing right now, but I don't think inflation would be egregious at any point of time. Yeah. Also, price to earnings depends on earnings growth, which in turn is related to nominal GDP growth. When in case of India, that's about 12 to 14%. Price to book depends on return on equity, which also tends to be a little higher for India, right? So I think the fact that valuations are higher for India, they are underpinned in those long-term structural variables. The only thing is we can't rely on those variables remaining high, without seeing an actual reflection in the earnings environment.
Okay. The other bit is, Manishi, in the last 2 years, we've seen a lot of sectors get created in the Indian markets. Yep. Insurance is the poster boy, maybe, but in a small way, I think the last 3 years have also belonged to the specialty chemical space.
Right.
Dairy as a space has really come of age and has found presence too. What within this newly created pockets have you guys within the Asia Pacific region taken notice on India?
Well, I think the most noticeable, the most important space is insurance, simply because it's the largest. Yeah. It's also because in the region, particularly North Asia, if you look at China or Korea, the insurance space has been listed for quite some time now. While in India, where the penetration rates continue to be low and therefore insurance is an attractive business activity, the space wasn't listed, and therefore the only quasi ways of playing them through the conglomerate businesses was being engaged in by the international investor. Now they have a direct way of playing that. Which
are people open to it because they are expensive stocks.
They are, no doubt about that. Which used to be the case when insurance first got listed in North Asia as well. But I think most investors understand that to have a high quality exposure to a growth business in India, there's a premium that needs to be paid. Okay.
that settles the argument for now at least. But Manishi, so good having you. Thank you so much for taking the time out and joining us.
Great.
And have a good stay in India.
Thank you. Thank you very much. It's a pleasure to be here.
Thank you. Well, the Nifty Bank is up 2%. So the initial gyrations notwithstanding, we're doing very, very well on the Nifty Bank as well as the key benchmark indices. Take a quick break. On the other side of the break, though, we discuss the expectations from today's GST Council Meet with Pratik Jain of PwC, some earnings with Tata Sponge, as well as the whole metal space with Rakesh Arora of Go India Advisors.
What do we want from our country today? From the economy, from the politicians, the policymakers?
Do we want a better deal?
Maybe more perks for smaller businesses or large businesses or any businesses.
Do we want it to be easier to create something new?
To find the job of our dreams, to create jobs for dreamers.
Do we want growth? Not just for the sake of growth, but for what it represents.
Not just numbers on a graph somewhere, but prosperity that we can see, touch, feel.
These things we want.
Can we expect them realistically?
It's time. Time for us to accept less and expect more.
Time for us to get on the path to confidence once again.
Time to go from making promises to keeping them.
From manufacturing slogans
to really making it in India.
From a promising economy
to a delivering economy.
Can this budget mark a return to confidence?
Watch Budget 2018 with Bloomberg Quint.
Welcome back. You're watching Indian Open. Over the next 30 minutes, we're going to cover lots of ground. GST, Tata Sponge, and of course the metal space. Let's kick it off with GST. It's the last GST Council meeting later this evening before the union budget. A quick heads up on what to expect. Joining us is PwC's Pratik Jain. Pratik, good morning. Thanks for joining us. A bunch of things that seem to be on the agenda, ranging from simplification of filing forms to potentially another expansion in the composition scheme of some sorts. And then, we had the Business Standard story yesterday that suggested that there might be a rate cut for up to 70 products. What are you expecting?
Yes, so 2-3 things largely. As you said, the biggest thing in the agenda is simplification of returns. 2 things there. A, the compliance levels are still very low. People are finding it very difficult to file 3 returns in a month. And the government is also facing a lot of opposition on that. So the thinking is that the GSTR 1, 2, 3, which are 3 monthly returns, could be combined into one. And that could either be monthly or it could be quarterly. And also the reconciliation, while the invoice matching will continue, it will be done on the back end by GST. And that means that you no longer have a requirement that the vendor has to approve the invoice before the purchaser gets the credit. So that would be a major simplification. Let's see how it works, but that's a major one. On the rate cut, we are expecting some rate cuts on the services. For example, housekeeping services, carpentry services provided through online platform is liable to 18% GST irrespective of threshold. So, and most of them are below 20 lakh. So we are expecting that 18% to be cut down to 5%. Some of the job work services, handicraft related job work, etc., could come down as well. I don't think that there are many products where the rate would be cut. That's not in the agenda this time. That will be taken up subsequently, except for a few like biodiesel and electric vehicles, etc. is what we have been hearing, but largely on services. And the third point in the agenda would be legislative changes. As you're aware, that there was a law committee which was set up in November. They have provided a detailed recommendations. So there are many things that they have recommended, and I think some of those things will be debated. And if the council approves, then as part of the budget session, it might get an approval of the parliament as well. So three things. One is the compliance ease. Second is the legislative changes, and third is rate cut, but largely on services is what we're expecting.
These legislative changes, Pratik, can you throw some more light on what exactly you're anticipating will those changes be, and how they will impact both the implementation of GST and at the end of the day compliance?
Yeah, so there are various changes which have been recommended. Around 16 major changes is what we are hearing. The first set of changes are with respect to input credit. So the recommendation is that input credit provisions should be liberalized. For example, today if I hire a cab for my employee, that's not liable for credit, GST that I pay. The committee has said, and rightly so in my view, that it's a business expenditure, it should be allowed as a credit. Similarly, on some of the other expenses, they have said that input credit provisions need to be liberalized. On reverse charge, I think the recommendation is that when you buy something from unregistered dealers, it has been deferred till March. They're saying to defer it further. Then there are few recommendations on account of ambiguities in law. For example, transaction from SEZ to domestic market. As per the law, it's subject to tax twice. So they have said remove those anomalies. So there are various sets of these recommendations. Which either are because of ambiguity in law or because of the structural issues like input credit. I mean, if you want to have a more global GST, we need to have a global GST system, and any business expenditure that I incur, I should get a credit. So all of these changes are changes in the right direction. Obviously, government will have to weigh it against the revenue sort of collections dip which they are facing, because anything liberalization that you do on input credit will mean dip in revenues as well. And also there are reports that real estate might also be discussed today, that whether real estate should come in GST or not. But I think it will be initial discussion today. It will no decision will be taken today, but at least the debate would start.
Okay, I just want to go back as a quick last question to the invoice matching point that you made, Pratik. There's been a lot of debate on this, some people calling for it to be done away with altogether. You've indicated that they might simplify the way invoice matching is done. So they won't do away with it, but they might move the burden of invoice matching to the back end and not to the front end. Does that in any ways change the fundamental need to invoice match as a self-regulating tax system? Do you believe that there is need to do away with invoice matching altogether? What do you think will be the best path from here onwards?
No, not at all. I believe that invoice matching is a part of the basic fabric of GST law. It should not be done away with. If it is done away with, then much of the benefit that we are expecting from GST in terms of stopping the tax leakages would not come through. I think what's going to happen is that the earlier system, the way it used to work was that the vendors would raise an invoice to me as a purchaser. Let's say there are 100 invoices that they raise. I find that there are 20 invoices that are missing. I upload as a purchaser the 20 invoices on my own, but those 20 invoices had to be approved back by the vendors before it became a credit. GST is taking a view that we don't want to do this mediation and reconciliation between you guys. You sort this out on your own. I will give you a report. I will give you a mismatch report saying that these are the invoices which are not there, which either the vendors have not uploaded or you have not recorded, and then you figure it out with the vendors, right? But the invoice matching as a principle would continue in all probability. I think it will be very unfortunate if, because of the pressure from various quarters in the industry, and many of them really are from unorganized sector who don't want to comply, we will completely do away with invoice matching. So I don't think that will happen, and that should not happen.
What would be the commercial implication on both businesses and government revenue if this moves to the back end? Because, you know, as you've explained and as I've understood it all so far, is that if your vendor, says in his filing that he issued 100 invoices or he issued 80, and you say in your filing, going by your illustration, that no, they were actually 100, and you upload an additional 20, the front end system shows, does not allow for the reconciliation of these two, and neither of you can process or progress further in the ability to claim any credits on behalf of that part or those transactions. If you move it to the back end, you will be able to claim the credit, but if there is a dispute between the two of you, how will it work from a back end point of view? Will that change the way, the credit is accrued to you or the way government accounts for the revenue?
Yes, sir, it will change a bit. So what will happen is that as a purchaser, I'll go ahead and claim the credit based on what I believe is the right credit. Now, if the vendors have not uploaded the invoices, I will have to then exercise that greater control over vendors to ensure that the vendors do upload the invoices on a timely basis. So onus, which to a large extent was with GSTN, is now shifting to the business. And that would also mean that, as from a credit perspective, there might be more instances where more credit would be claimed initially, and that would mean that lower revenue for the government. But then it will settle down later because after 2-3 months you have to true it up. It will also mean from industry perspective that they will still have to have some manual intervention, and they will have to produce a lot of documents at the time of assessment and scrutiny. So it will not be as faceless in tax administration as we are all expecting it to be. So because if there are reports which are given to you, and after that you have to go to assessment and scrutiny, you will have to go with the reconciliations to them. So that's the flip side which I see to this approach, but obviously much more simpler than what
it takes away
right
so
now.
dramatically from the ease of what this tax was supposed to be, but that so much of that ease is already dead right now. One final question, Pratik. I know that every month we speak to you, you say next month you'll probably have more visibility on GST revenue and how it's panning out for the government. You mentioned right at the start of this conversation that compliance is still not looking very encouraging. We're now in January. In a few weeks from now, the finance minister will be presenting the budget. Any better understanding of where we stand with GST revenue?
Unfortunately not. I mean, I think December 27th was the last date for filing the Tran 1, which was for opening credit. So December revenues will get impacted, which you will see in January 20th. Around that time, you will get that number. I don't think that you will get a real picture. You will only get the real picture when you look at the revenue collection from January to March, and and government has to walk a tight rope because 1st February is the budget. So the only tinkering that they can do is on custom duties. What we're hearing is that some of the electronic products, the GST custom duty could go up because they want to encourage manufacturing in India. So some of those things could happen. Petroleum products could see some changes in the duty rates. But as of now, I mean, I'm not able to really take a second guess on that. I think January to March is the quarter which will give you the real picture, not December numbers.
All right, Pratik, appreciate you joining us this morning. It's been a constantly moving target, this ability to understand GST revenue. And man, you've got to have admiration for the finance minister. He'll be going into this half blind when it comes to revenue, or at least not with a clear picture, as everybody seems to be pointing out, unless he has just a much better reading of all of this than any of us do.
By when would we get the details out today?
By later this evening, I think by about, I think normally the source-based stuff starts emanating between 5 and 7, and then you'll have the finance minister host a press conference on behalf of the GST Council to announce the main decisions. So that usually happens at 6 or 7 p.m., depending on when they conclude and how much they have on the agenda.
A long day for you then. I guess for a lot of other people.
Not new on that, yeah.
Yeah, but okay. It's been a very good quarter. Moving on and to earnings, very good quarter for Tata Sponge Iron. Let's get in the MD of the company, Mr. Sanjay Pattnaik. He joins us right now on the phone line to talk about the quarter and the outlook ahead. Good having you, Mr. Pattnaik. Thanks so much for joining in. Congratulations on a good quarter. Revenues, not just for the quarter gone by, but I think for the 9 months have been pretty strong. Do you see this trajectory continuing both on price and volume front?
Thank you very much. I think it has been a good set of numbers, and primarily the increase in the NR has been, I would imagine, because of the cost push, and the demand pull has not yet come in fully, but now I see the market picking up, the demand picking up because of the various schemes that is being implemented by the government and all. So therefore, I would imagine that the numbers would continue, the market would remain good, and we would see the similar numbers in quarter 4.
50% odd top line growth is something that you believe can happen, and if that is indeed the case, do you expect FY18 to be a number of somewhere around 750 to maybe 800 crores in terms of top line?
Yeah, I would expect it should be around 750.
750 crores. Okay.
Yeah.
What about the operational numbers? They looked very, very robust. I know the raw material costs have come down. You've contained employee expenses as well. But there have been changes between December and now. So how does the operational picture look like now? Can you repeat what you've done, which is about a 20% EBITDA margin?
The input costs have slightly gone up, and I would expect, especially the coal cost has gone up. The imported coal price has gone up, and we are also facing a lot of logistics challenge. There has been shortage of wagons, so therefore we are not being able to get it from the nearest port, that is Paradip, and we are incurring extra expenditure getting it from Gangavaram and getting it from Vizag and other ports. So I would expect that there would be increase in the coal cost. There would be increase already because of the penalties that the miners have paid on account of the order by the Honorable Supreme Court recently on iron ore mining. So therefore the iron ore cost has also gone up. And I would expect even the iron ore cost also to go up in quarter 4.
So,
but we expect that the NR to remain strong or go up further. So therefore, that will be absorbed by the increase in the sponge iron price.
So 20% EBITDA margins are sustainable.
20% EBITDA margin to me appears to be sustainable.
Suspension of the iron ore mines in Odisha, does that have a material impact on you, Mr. Pattnaik?
It's not, all the mines are not closed. The availability is there, but I think some of the mines are closed, but the government is taking initiative to open those mines. Okay. Availability, I don't think would be a problem. And in any case, we source our iron ore from the captive mines of Tata Steel.
Tata Steel. Yes, that's true. Okay, one last question, Mr. Pattnaik. You've gotten an approval for building a long steel manufacturing plant. Would you need to raise any funds for the same?
It's still work in progress. We are finalizing the process route. We are finalizing the asset configuration. We are finalizing the products. So all these are in a very advanced stage of discussion, and we are deliberating amongst ourselves, looking at which route would be the best suited for us. And obviously capex will be a major consideration, how to execute the project at the least capex so that we remain competitive and we don't land in financial problem. The company is in a robust situation now, and we don't want the company to land in any kinds of financial problems. So that is all being finalized, and it's work in progress. As and when it is finalized, we will report back to you.
Okay, Mr. Pattnaik, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us.
Thank you very much. Bye. Thanks.
All right, we continue the metals conversation now, but this time with an independent analyst. Metals across the globe have had a stellar run in 2017. What does 2018 hold? We're joined now by Rakesh Arora, Managing Partner at Go India Advisors. Good morning, Rakesh. Thanks very much for joining us. Look, there are two things that we were very keen to talk to you about in this conversation. One was how you see both commodity prices and therefore the ability of Indian commodity companies to be able to move into expansion mode this year. And, you know, playing into that is the big inorganic route through the stressed assets situation. You know, we've seen many of them go through insolvency proceedings at this point in time. So let's start first with your 2018 outlook and what that means for many of the Indian metal companies. Which ones stand out the most for you?
Okay, so see, 2018, you know, commodity companies are starting at a strong footing because global growth recovery continues, and it is expected that global growth would be on par or better than 2017. And number two is that Chinese, you know, capacity cuts continue. They have reaffirmed their, you know, decision to cut down obsolete and polluting capacities. So to that extent, there will be further cuts which will come in China. And number three is that, you know, dollar has been weakening. So that also really supports commodity prices. You know, the cost for manufacturing goes up when dollar weakens, and that is compensated by rising commodity prices. So for the first half of 2018, things look really strong. Second half of 2018, it's too early to call. You know, commodity market is not that predictable, and it will all depend on how Chinese demand plays out post the Chinese New Year, and whether the Chinese government really, you know, supports the economy by continuing the infrastructure spending, etc., or they take the foot off the pedal and, you know, allow things to drag down. So second half of 2018, you know, unsure, but first half looks reasonably strong.
Which of the Indian commodity companies or metal-based companies do you like the most? For instance, we're seeing Tata Steel now make a big bid to expand capacity in India and attempt to regain its #1 leadership position. JSW Steel very, very aggressive on acquisitions for those stressed assets in the insolvency process. Vedanta also looking at maybe building out its steel portfolio. What strikes you as most attractive?
Now, see, that's the challenge. Globally, the capex recovery for metal companies is extremely slow, whereas Indian companies are really pushing ahead both with organic and inorganic expansions. That doesn't really bode too well in case things were to turn down, you know, in the second half of 2018 or later. So I would say that one needs to be a little bit cautious on, you know, companies which have high debt and are continuing to expand, because in the downturn they will face that same situation again. Most of the global companies are not really looking to repeat that mistake. So I would suggest that, you know, one is better off looking at cash-rich companies like, you know, Coal India, NMDC, Hindustan Zinc. These are cash-rich companies, and they should, you know, do better going forward.
You sound a little disapproving of Tata Steel's plans. JSW's effort is at least still towards consolidation in buying existing capacities. But you sound a little disapproving of Tata Steel's $2 billion capital raise and the effort to, you know, build out more capacities, especially at Kalinganagar.
No, actually, the $2 billion capital raise is a positive thing. Without that, you know, we would have been much more negative. Okay. But given that they're doing a capital raise, it really helps, you know, the balance sheet, and they can afford to do a little bit of capex. So I won't say that we are, you know, disapproving it of, but we are a little bit cautious and neutral at this juncture. Valuations have risen, and companies are taking additional, you know, capex. So one needs to be a little bit cautious before things settle down.
Okay, before I come to the insolvency process questions, you know, there was a question I wanted to ask you. I was talking to a group of CFOs who suggested that maybe this time round, when it comes to private sector investment and capacity expansion, it's the commodity sector that might lead the charge. What with, let's say, cement companies wanting to expand capacity or steel wanting to do that. Do you sort of subscribe to the same belief that they could lead the charge? And do you think that could be even a sustainable charge if key demand industries like infrastructure don't pick up?
Yeah, so I mean, already intentions have been shown by both steel and cement makers to increase capacity organically also, and because demand in India is growing at 6 to 7% for both these commodities, and for steel, for people to maintain their market share, we need a capacity increase at least of around 6 to 7 million ton a year. So somebody or the other will have to expand if they want to maintain their market share. Same is true for cement. Cement, the demand is around 300 million ton, growing at 6 to 7%. So they need around 20 million ton of capacity every year. So people, and most of these companies in cement sector particularly have strong balance sheet. So there's nothing which is stopping them. Steel, of course, there's issue of balance sheet, and Tata Steel has resorted to raise capital. So they are able to expand organically also. So I don't think these companies can make a material change to the capex cycle. You need big ticket items like oil refineries and infrastructure really to pick up for that capex to really start rolling.
Okay, this insolvency process issue, I mean, there are many ways to look at it. The fact that there is some fairly aggressive bidding going on for some of these assets, JSW looking to maybe buy something in the West to supplement, its current capacities, Tata Steel looking to acquire to be able to get back to number one, Vedanta looking to add to its steel portfolio, ArcelorMittal also in the fray. Which ones are you watching most closely? What stands out for you the most?
See, there are only two large assets which are of interest and where there's going to be intense bidding. One is Bhushan Steel and Power, and the other is SR. So these are the two which where everybody is interested, and the whole world is watching who is going to take them. Apart from these, there's a long tail, and not many people are keen on them. We saw that Electro Steel Casting saw very tepid bidding, only two investors putting up their bid. So, apart from these two, I don't think there's too much interest in others.
And Bhushan, who do you see that being the best fit for?
Now, see, Bhushan has, a good portfolio, and most of the guys who are looking to enter into India would be very keen to take a, strong hold. It gives them access to auto-grade steel, etc. So, companies like ArcelorMittal, etc., if they have to come to India, this is one of their best chance. So they should be aggressive. As you rightly said, JSW Steel is also keen to grow into West. So for them also, it could be strategic fit. So these are the two which are front runners, and then maybe Tata Steel.
Interesting. Rakesh, just a quick perspective. Which of these, from a minority shareholder's perspective, which of these stressed assets seem to be the one which will, reward people who stay put? Because almost all shareholders are in a dilemma whether to stay put with these or just get out of it before the whole process ends.
See, if you ask my view, it is better to sell, if you are holding any of these companies, because we are talking about a write down in the debt, and there is zero equity value which will be left. When these companies come in, they will infuse capital, and they will dilute the existing shareholders to a very small minority. So I don't think they will get that much value, and then they will have to wait for things to turn around and all that. So right now it makes no sense for shareholders to own any of these companies. You saw what happened in Electro Steel. The debt is around 8 to 10,000 crores, and the bids are only for 4,000, 5,000. So it makes no sense for any of these equity holders to stay put.
One of the finer projects is the SR Steel one. You said you expected it to be, a highly competitive bid process that will take place. You think that the promoters stand a good chance, the Rhea family, to be able to reacquire the project? We heard that they're trying to deploy interesting, innovative structures to be able to do so. What's your take on who might end up with SR, or who should end up with SR?
See, nobody knows the projects better than the existing promoters, so they can actually bid at a much higher level because they don't have to plan for contingencies which other players would have to do. So theoretically speaking, existing promoters, which in this case SR Group is favorably placed if they are allowed to bid and they can bid.
Okay. I think Neeraj has a question on cement.
Rakesh, I'm just expanding the scope. One last question from my end. Binani Cement interested me simply because now, aside of the entrepreneurs bidding for it, we also have Rakesh Jhunjhunwala and Radhakrishnan Damani bidding for this asset too. What do you make of this fairly interesting development, if I can call it that?
I mean, cement has been, darling of a lot of stock investors for pretty some time, and it's been trading at crazy valuations. So clearly, there's interest in cement companies. Binani per se is, a very good asset. And if you look at the valuation differential between a pan-India cement company and a regional cement company, it's almost 2x. So all the companies which are not pan-India, in this case, Dalmia, Heidelberg, JSW, so they are all keenly looking to acquire this asset, and this will give them a strong foothold into North region, which is landlocked, and limestone availability is also limited. So to that extent, it makes it very attractive, and that's why you see this kind of intensive bidding happening. The bids that we are seeing are around replacement cost, so it's not really very high. But still, given the euphoria around cement, there's so much of interest.
All right, Rakesh, I know we have many more questions, but this is going to be an ongoing process for the next few months, so we'll reconnect in a few days from now. Thank you very much, Rakesh Arora, for joining us and talking us through very quickly on his outlook for the commodity sector and the insolvency process assets. With that, we're wrapping it up here on Indian Open. Up next is the F&O Show.